Good evening, everyone. It's my pleasure to introduce Uma Shashikant. Dr. Uma Shashikant needs no introduction, but I'll make an attempt. For all those who've been around for a while may know her from her UTI, ICM, ICICI Prudential, or ING Optimics days. Uma continued her journey as an entrepreneur and co-founder of CIL. CL continues to immensely benefit from her inputs on strategy and content as a chairperson. We all know Uma from her insightful personal finance articles in ET Wealth that we look forward to reading every week since 2010. NSE has been in the forefront of creating investor awareness on the passive investing style, especially ETFs, and helping us realize how it is the champion product for wealth creation. This is also a subject which Uma is very passionate about, and she has written extensively about it. Uma joins us today to enlighten us on how we may use ETFs in asset allocation and incorporate it in our portfolios. Over to you, Uma.
Thank you. Thank you, Niyati. It's always a pleasure to be here to talk to investors, advisors, and everyone else about wealth management and wealth creation. Most of the time, the portfolio construction decision is fraught with this difficulty of product choice. What to choose, how much to choose, where to invest, when to invest, which is the right product. And as investors like to ask, which is the best product? I must add, there is no such thing. But however, there is this question of product choice at all times. What I'm here to talk to you today is about a default product or a product which doesn't require all of these questions and consideration. Something which is simple, straightforward, and basic, that it needs to find its place in every portfolio, which is the index product available as the index traded fund, traded on the exchange and easy to buy and sell. So today's session will look at where does the ETF fit in an investor's portfolio. We all understand that the investor, when we say portfolio, obviously, there was a question about it too. When we invest, we are not investing in one product. Much as we try, our money is in gold, is in real estate, is in the bank, is in bonds, is with the post office and the government, is with mutual funds and in equity shares. Now, all of this is what we call as the portfolio. Now, instead of it being a mishmash of various things, we can strategically kind of see how this portfolio is created so that we're able to get our wealth to work well for us and for, optimization, if I may call it. Therefore, what we're going to do today is to see how ETFs fit within the overall approach we may have for investing our money and creating wealth. Let me share a presentation that I have that NSE has put together. Yeah. So here is the presentation I'm going to run you through. I will take the first half an hour to 40 minutes to run you through the points in this presentation. And then from the questions that were sent to us before the start of the session when you registered, we've chosen a few questions to answer at the end of the session. So we shall do that at the end of the session. Please feel free to use the chat window to ask any other question that you may want answered. Okay. Now, when we talk of the index fund or the exchange traded fund, ETF from here on, we're talking of what is called passive. Okay. Now, there are two ways to approach investing. One is called the active approach. The other is called the passive approach. Now, when we say active, that is really what most mutual funds and other portfolio managers, as well as investors who pick stocks. As long as you're not holding one stock, you are still an active investor who's holding multiple shares, right? What active investing tries to do is to time the market, decide what is the right time to invest, when to invest, which one to hold, how much to hold. So you're making multiple decisions for your investment. When you create your share portfolio, you're making these decisions actively. The objective for doing this is to get a higher return. I mean, that's a very qualified statement, but that's the objective. Whether we get it or not is another question, but you want to get a good return, so to say. Now, when you are saying passive, what you try to do is you don't want to make these decisions. You simply don't want to make these decisions. What you're doing is there's already an index that is available. Everybody knows the Nifty, right? Now, NSE has a separate professional team that manages a series of indexes. There is Nifty, there is Next Nifty, there is a mid-cap index, the banking, financial services index, IT index, and so on. So what NSE has done is to bring together, so when we say portfolio, multiple stocks, so bring together a set of stocks and create an index. So an index is nothing but a portfolio. Now, technically, we call the index as a benchmark, or we call it as the market portfolio. The reason we call it that is that this is like a default, like this is the benchmark or the level of return you should get if you just ran with the market. Okay, so if you say Nifty, you are looking at multiple sectors. There are 50 stocks there, right? And these are very actively traded. You're looking at multiple sectors. You're looking at top names, because for a share to be present in the index, it needs to be highly traded, right? Very liquid. And stocks of this kind are usually market leaders in their segments, large cap, established businesses, leading businesses in their sector. So these are what we would call as blue chips. So what happens is when you buy the index, you are buying a pre-selected portfolio, which has been put together through independently. You're not making any of these decisions. So when you buy this ETF, you're buying these 50 shares in a pre-fixed proportion already. So you buy one product and you get exposure to all of the shares that are in the index. That is what passive investing means. That is, you don't make an active call on where to invest, how much to invest, when to turn. So every time the index is revised, your ETF will get automatically revised. So it's an easy, simple, low-cost way to be able to invest in the market. Product is extremely popular. Why it is not very popular with the individual investors, we will come to a little later. Essentially, the number of investors, now you would be mistaken if you think that only individual retail investors buy ETFs. A large proportion of ETFs are held by institutional investors. It's extremely popular with pension funds, extremely popular with insurance businesses, extremely popular with foreign institutional investors. So ETF is a simple, ready portfolio that is available for quickly, easily, and at a low cost buying. So that is really the proposition. That's where the product is positioned. Now, the question that comes to an investor's mind is, why should I buy this index? Why can't I not select stocks by myself? Or why should I not invest in a fund, an active fund in which stocks have been selected already and managed by a fund manager? Now, as I said earlier, there's nothing like the best product. So I'm not even trying to pretend that ETF is the best product. All I'm trying to say here is that there are various ways in which you want to do this. What you need to remember is that there are two kinds of returns. Okay, there are two levels which we say as returns. One is the beta return or the default return. So you're present in this market means you will get a certain level of return by virtue of being present. For all the effort that you make, you try to select, you try to time, you try to increase, you say, no, I'm not having banking, I'm going to do IT. No, IT is not going to do well, I'm going to have oil. Okay. So all of those active things that you do, you try to generate what is called the alpha. Now, active funds try to generate the alpha. So you have two levels of return. You have beta and you have alpha. Now, your default return is the beta return, which makes it possible for you to keep it as your base. So when you're talking of an index fund, you're looking at the base return, benchmark base return that you must get if you have the exposure to equity. For example, if you're a retired investor, you're a first-time investor, you are someone who doesn't like equity trading, but you still like the fact that equity returns are good. You don't have to answer questions on which stock, how much, etc. Buying the index will give you that exposure. So you get a portfolio of top quality stocks. You don't have to do any managing. It is the basic representation of the market. So now, why not active funds? There are many people who would say active funds are providing a better return, right? Why should I not be investing in the in active funds? Well, that case is good because if you looked at the kind of returns that active funds have provided, these returns are higher. There's nothing to scoff about, so to say. The problem, however, in this table, I want you to look at the last line. Okay, there will always be, let me say always, okay, there will always be some funds that are doing better than the index. As I told you, the index is the benchmark. So there are funds that will do better than the index. There will be funds that will do worse than the index. The problem really is this, that investors have no formula to choose the best funds always. It's not the same funds. You see 13 out of 29, 8 out of 29, 15 out of 29. So about half the number of active funds, large cap funds that are in the market are doing better than the index. You don't know which one it is. And typically investors will buy last year's winners. Now, that can be actually a strategy that may not work, right? Something is doing well, then you go and buy it after the fact. So when you are choosing an active fund, you have this prediction risk. I'm sorry about that fine print there. Those are the names of funds. Would anyway not want to delve into the names. All I'm saying is that a different fund will do well in different years depending on what strategies they followed, what stocks they picked, and how those stocks performed. Let me tell you this, in 36 years of being in this profession of investing, I can tell you no one has still found the formula for success. No one. So let's not kind of chase that idea that somehow there is a winning formula that will place me at the top. No, there isn't the best food to eat. There isn't the best friend to have. There isn't the best dress to wear. There isn't the best dog to buy. So there is always a risk. So what you want to do with index fund is to use what we call as default. Now you have money in the bank, or you have retired and you have a corpus which you have to invest, or you have sold a property or liquidated gold and you have money to invest. You're wondering where to put that money, or you are a saver who's routinely generating surpluses every month. It is going to be very onerous to make this choice every time. Which fund, which stock, how much, when. If you used a product like an ETF as your default product, that is, when I am in doubt, I'm going to put it in an ETF. Let it be parked here. And when I make the decision, I can do what I want with the money. One. Or I make sure that a part of my portfolio, however, is earning the beta return, right? It's earning the default basic return. And I get my exposure to equity by simply investing in the index fund. And the advantage for me is now, what is it that I don't incur? I don't incur the management fee. I don't incur the administrative expenses. I don't incur distribution charges. Now, why will you incur these charges? Like an active fund will be about 1.5% of charges. Why? Because the fund manager hopes to make a return which is better than the index. So the choice in front of the investor is very clear. I earn the basic return at the low cost, or I incur additional costs and hope to earn a higher return. Now, in every investor's portfolio, there is a place. I mean, when you put a meal together, you will have your dal roti or your chawal roti in place, right? It's only, you will make a choice on what are the other sides that you will have. So there is always a basic default choice that you will anyway make. So the basic default choice would be your ETF. This we have discussed already. I mean, who could say it better than John Bogle, who said that, why do you want to look for a needle in a haystack when you can buy the entire haystack? So the idea is really this, that there is a ready portfolio of well-traded top stocks, which are blue chips, which is available as one product. You don't have to buy these 50 stocks individually. You buy the index, you will get all of these, right? So there is a product that is available. Your broker, you have a demat account and or you have an online trading account. You, with a click of a button, you'll be able to buy this product. And it comes at a very low cost. The cost of an ETF is it's the cheapest product for the cheapest exposure that you can get to an equity market. So if you agree to run with the market, this is the product that you would want to look at. Now, so this is the, we mentioned this point again. So that is part one. Now we want to look at How does this product fit into your portfolio or your wealth creation strategy, and what kind of asset allocations are possible? Now, let me put in a word of caution here. People ask for proportions. They say how much, what proportion, what percentage should be in the index funds. Now, there are people on low carb diets who don't eat rice at all. Is that right? Or they say, I will have 80 grams of carb in a day. So, personal finance is what it is. It's personal. It is curated to your requirement. It's curated to your specific goals, your specific needs. And it is wrong on my part to say, put 50% in ETFs, put 40% in ETFs. No. So it is not in this session. In this section, I'm not going to kind of tell you actionables in terms of how much should be put where. But I will tell you what should guide that decision. When you make this choice, how much should be in index funds, you need to be very careful about what is it that you want to do with your money. So let's go ahead and look at. Now, this is the metrics that investors don't like at all. They don't like it because everybody would ask for, can I have a product with capital protection and growth? Can I have a product which has a growth and which provides a high return but has no risk? So these combinations are really difficult to achieve. It is like saying that, can I have a spin bowler who will also score runs? Okay. In your portfolio, each product has its place. A bowler has his place. A batsman has his place. A batsman may come in when the bowlers get tired and bowl for an over, right? He may or may not take a wicket, but you're not going to enter the match with the strategy that you're going to have someone to play all the roles. What you want to do is you want your team to be the winning team, right? You want your wealth to grow. You want your portfolio to be the winning combination. That's really your strategy, where you're trying to say, okay, this guy cannot score a run to save his life, but you can be sure he'll take wickets. So that is the kind of approach you want to take when you look at asset class mixes. So if you're looking at your short-term deposits with the bank, the return will be low, the risk will be low, the capital is protected, right? But if you are looking at equity, I'm just skipping the first part and coming down to equity. If I'm looking at equity, in equity itself, I can go with business leaders, large, well-established businesses, which we call as blue chips, right? What happens with these businesses? They have grown so much, right? They are market leaders. They have a steady level of revenue and profit, right? They can borrow, they can raise capital at the lowest possible rate. But what happens? They actually don't require capital because they may not have great expansion plans, or they may generate enough internal surpluses that they will pay a high dividend and will not be very keen to kind of acquire new businesses. Whereas you're looking at a small business, begin and they're working and they find an opportunity, they will say, oh, this enables me to grow inorganically. Let me find money and acquire this business and jump to the next level of growth. It takes no guessing to find that the small business, which is doing this absolutely, bold strategy, has the potential is the operative word, has the potential to offer a much higher return than an well-established business that is not really making capital investments but generating a lot of cash. But the market turns. So you have a situation where, like the post-COVID induced situation that you have in the market, where businesses are unable to grow their revenue. They are unable to meet the demand. They have various supply chain problems. They are unable to retain labor, and so on. And interest rates have gone up. Large businesses will be resilient. They will stay. Small businesses will suffer a very high risk of failure. So which one will you choose? Should you you chose a small business for the possibility of a spectacular return. You run the risk of possible business failure. You choose the large business for the fact that it's a established business with a steady revenue and resilience to business cycles. You find that the returns are average returns, and you're not likely to make an above market return. which is why the portfolio. You want to construct a portfolio in which you want to add components of all of these to be able to build your wealth. Now, when you construct a portfolio thus, you want to be able to include in it components for three reasons. One, you want to, risk return and liquidity, everybody knows that. But let me kind of rephrase that. You want to build a portfolio such that it's aligned to your needs. Your child is going abroad next year and you have to pay fees. You don't want your money, the money that has been earmarked for the child's fee, you don't want it in the equity market. You would have put it in the equity market so that it grows. Okay. You started investing when the child was 1 year old. You've invested until the child is turning 18. For 18 long years, you have a growth goal in mind. You will put this money in an ETF, in an equity portfolio and allow it to grow. The child is going next year. You don't know how the market will behave next year. What would you do? You would pull this money out, put it in a debt product, keep it in the bank so that it's not affected by any risky event that can happen in the market. Is that right? So how you will invest, how you will combine will depend on your need. There is no denying that at all, okay, your need. The second thing is that you will look at it in terms of broad ideas of what is important to me. Is income important to me or is growth important to me? Right? So if you want growth, if you want your portfolio to appreciate in value, you would choose an equity product over a debt product. If on the other hand, you're a retired investor who's looking at primarily getting income, the dividend income may not be enough. Dividend yields are very small. So you would want to put a percentage of money in fixed income products and have, why would you have equity as a retired investor? You would have equity so that you fight inflation, the value of your investment keeps growing. Okay. And the third thing is that somebody who asked this question, why do I need anything else other than equity in my portfolio? Right? Now, if the market crashed, to the extent to which you have put money in non-equity products, your resilience will be better, right? So when people say you have to book profits, what does booking profit mean? Booking profit means taking money from a market which has appreciated, pulling that money out and putting it in something else which is safer and steadier than the risk in the market. So therefore, when you build a portfolio, you want to combine products, you want to combine keeping these three things in mind: your goals and your needs, your requirement for income and growth, and your ability to tolerate risk. Now, let's go ahead and look at the details. For example, now suppose you were to consider, we are looking at ETFs, right? Where does ETF fit in the portfolio? ETF very clearly fits in the core. That is to say, a portfolio that will run along with the market. Okay, you don't have to worry about what is in it and how it is performing, but whatever happens in the market happens to the portfolio. That's a fantastic strategy, right? So you want to have the core of your portfolio, that is the main component in your portfolio, to be in an ETF so that you're able to get equity exposure. Anybody who's wondering, should I have equity exposure? Should I be investing in equity? A first-time investor I would advise choosers an ETF because it gives you a taste of the market in the most secure way and diversified way as possible. Now, suppose you are an established investor, you would still look at ETF as your default choice. When the choices are too many and the failure of the worry of regret and the analysis required for making a choice looms large, it's good to have a portfolio in which you will have a default amount invested. Now, this picture is just a representation of how you will construct. For example, please do not pay too much attention to the proportions. They are not cast in stone. They are just indicative. Okay. So let's assume that you have about 50% of your money in large cap, well-established businesses, which is the ETF. Okay. You have ETFs. Okay. Now, this provides you the beta return, or this provides you a return that comes from, let's say, holding 50 top stocks in the market, which are highly liquid, which are business leaders, right? At the lowest cost possible. This is what you've done. However, what you want to do is you want to tactically make some adjustments. You want to kind of enhance that return in some way. I will explain these ideas. So above the core portfolio, you will add a few tactical adjustments. Oh, bank is doing better. Technology is doing better. These are at this time, I don't know whether recession is going to hit. Maybe I should have gold. Okay. So on and so forth. So you make some tactical adjustments. And then you do what is called portfolio completion. What is portfolio completion? My portfolio has everything, but doesn't have this. Okay, I have all Indian stocks, but I do not have, for example, international stocks. You can buy global ETFs to fill that gap. I have everything, but I don't have a commodity exposure. I can fill in a commodity index to complete the portfolio, right? So portfolio completion is another strategy. Then liquidity management. I might need the money. So let me kind of keep it where I can take it out easily. Or I have some money. Before I make a decision, let me park it somewhere. So that is your liquidity management. So you'll have a little bit of money, liquidity. Rebalancing. Sometimes you'll say, oh, the markets are looking like this. So I want to be able to move my money from large cap to small cap or from small cap to large cap. I explained the business failure and resilience idea. So you want to do that. Or markets are looking very hot at this point of time. So I want to reduce some amount of money. So the point you must remember here is all of these adjustments, you see how small the impact is. They make very little difference to your final wealth. What is in your core and what is in your tactical satellite is what will make the biggest difference. Okay. And whether your portfolio is complete and well diversified, well exposed, that is what will make a difference. All of the strategies of moving your money up and down and, trying to time, etc., will do nothing, which also means that with ETF, you can have a buy and hold strategy. Now, when this is what I explained, I've already explained this, I'll skip this. So what you can have is you can have a large, how much is the core is the question that you have to answer, right? So suppose you are, for example, an investor in your mid-30s, mid-40s. That is, you're earning, you're generating a surplus, you are regularly investing, you have no requirements for income because you're getting your salary, but you are worried about your retirement, your children's education, and such long-term goals. Your portfolio has to be growth-oriented. You must have equity, but you don't have the time. So your core portfolio will have to be ETFs because you have very limited time for satellite strategies to make a big difference to your portfolio. You put in a default. So put in a big chunk in your ETFs, which require no attention. And when you're building the satellite portfolio, make sure that you're using products that will add to this. Okay. Now, for example, let me show this. So let us say you have, this is a different one. I'll come back to that in a minute. On the other hand, you are a young investor, or you are a very active investor. You are still earning well and all of that, but you have this great fascination for the market. So you are holding your own portfolio, which you are actively juggling and trading. Then what you want to do is you want to use ETFs as a satellite where you will add a commodity index, or you will add an IT index, or you will add a global index, right? So what you want to do is, so the core and satellite can work both ways. You either have a core portfolio that is the ETF to which you have added other components, funds, actively managed funds, sectoral funds, and so on and so forth. Or you have your own portfolio that you're managing. You have a portfolio of funds, large cap, mid cap, small cap funds, and you have everything else, but you are missing a few components. So you're adding the ETFs as a satellite. Now you're a retired investor. You're looking at equity for the purposes of growth. Okay. You want to fight inflation. You do not want a situation in which all your principal is protected, but is remaining stable, unchanged. So your core portfolio is still income earning portfolio. Your ETF is your satellite. 20% of your money, 20 to 30% of your money is in a large cap ETF to be able to offer a growth component. So what proportions will lie where will depend really on how much you want to be active and how much you want to be passive. What works, what works is for you to go here. What works for you is to have a passive portfolio and an active portfolio. Do not assume that you can actively manage all components of your portfolio. I've met several investors who are eager to do it all themselves. And I have seen, I'm not joking here, I'm not exaggerating. In 8 out of 10 cases, the money is lying in the bank, savings bank, earning nothing, not even beating inflation. The reason why it is so is because they haven't made the decision. They do not know how to choose. So if you used index as your default, it is possible for you to just make this decision to say, let the money be in the ETF and let it work. It's an extremely liquid product. And whenever you want, you can make the modifications. So when we say core and satellite strategies, what we are trying to say here is one component of your portfolio is in index funds or in ETFs. And the other components are in large cap funds, small cap funds, mid cap funds, direct stocks, and so on and so forth, gold, international, etc. Whether these strategies are implemented through ETFs, all of these can be implemented through ETFs also, or through actively managed funds, is up to you to make the decision. So the ETFs are fairly flexible to be used in both ways for wealth creation. Now, sometimes what can happen is there can be gaps in the portfolio. As I said, you may not have international stocks. So you might want to add that to complete your portfolio. Sometimes, the funds or the stocks that you're holding, you're a value investor, highly value oriented, and you don't have a component of growth or a component of large cap, or you're taken in by this idea that mid cap is what is going to provide you the highest level of return. So you're investing in small unknown names. You're saying there's no money in established names. As I said, you want your portfolio to be balanced. You want your portfolio to be complete. You can add an index and that will kind of complete the portfolio and bring in a large cap component, which will offer you its benefits. Now, this is a table put together by NSE to just show, indicative percentages. So you have a core portfolio, which is in large cap, which is in Nifty 50. And there is some allocation to Nifty Next 50. And then in mid cap, there is a allocation to the mid cap 150 index, and the US large cap. There is a exposure. Now, all of this are index products, as you can see here. These are all index products, and there's a satellite strategy in which you have put in sectors. You have invested in the financial services sector, which is banking and others. You've invested in IT and so on. And what you do find is that you can bring together. So the idea here is you can build your portfolio with various components, right? And you can decide how these components will be. They can be all index. This shows that it can be all index and it can provide a fairly decent level of return. I am not prone to telling you, you will make 12%, you will make 15%, you will make 16%. If you're an equity over the long term, you will beat inflation. That's the simple idea. Your interest rate is aligned to inflation. Your interest rate is the rate at which business is borrowing. Every business that borrows will try to make a return which is higher than the rate at which they are borrowing. Otherwise, there's no point, right? Now, you can't be setting up these businesses. You can't identify these businesses before they succeed. So when you invest in equity, you participate in this value addition, the assets that earn a return higher than the borrowing rate. That return is available to you when you invest in equity. Now, earning this return is not like a stable straight line. It keeps going up and down, which is why equity is risky, which is also the reason why you will want to invest in a pre-selected, well-established set of names and make it easy for yourself. There are various ways to do it. ETF offers an efficient way to do it. The question to ask is, why is it that individual investors are not using it? Institutional investors use ETFs to also kind of buy futures and, because there are futures on indices and do a lot of trading, etc. But for the individual investor, it is for the purposes of having a stable, low-cost, well-known names product. Okay, it's a simple product. It doesn't jump around trying to time and select and all of that. Now, why is this product not popular with the retail investors? Because this product is a simple technical product created by the exchange. You just bring stocks together. It's very easy for the exchange to be able to bring the portfolio together and offer it as a product. There is no distributor here. So this is a product that the investor has to seek out. This is not something which is created by a fund house or by a portfolio manager or by an institution, which is advertised and sold and made available to the investors. No, there is no distributor here. There are no management costs. There are no distributor costs, which is the reason why it's a cheap product, right? So we can consider roti and rice to be very boring, but they are essentially basic, simple products available, widely available, low cost, and available to you to use. So this table shows you how you can have a complete portfolio made up of indices, made up of ETFs. So you can go all the way. It's up to you to decide how you want to do it. And then, of course, a small operational detail. If you chose an index fund is an ETF-like product offered by mutual funds. An index fund is very similar. I'll answer a question as well, in which where there is a difference between the two is spoken about. But how do you buy an ETF? It is like buying any other stock. So you have a trading account with a broker. You have to buy it through a broker, or you have a trading account with any online broking services. And you have an account, and then you will be able to, most of them are electronically enabled today. You need to have a demat account, and you buy it like any other stock, and you redeem it like any other stock. Okay. Whatever is the real time, today's price, the index is updated pretty much every nanosecond. Every time the price of the underlying stocks change, value of the index changes. So you will buy it at the current market price. You will sell it at the current market price. That's a big advantage for you when you use an ETF. So it's a simple, less known product only because it's not distributed, it's not pushed, it's not a push product. So that's broadly it. And we are at the 40-minute mark. That leaves us still with about 20 minutes to answer questions. I will stop sharing the presentation and be available to answer any questions that you may have. So do not ask this question of, do not be thinking of what is the right time to buy the index. Anytime, because it's a passive product. You run along with the market, right? And do not be worried about, is this the best product? No, there is nothing like the best product. Every product has its feature, and the feature of this product is that it is a simple, easily available, best in the market, high liquid product available like that in a click of a button. Easy way to invest in equity. So many investors who associate equity with trading. I have so many friends, when they know that I work in the investment business, they would ask me, I want to invest in equity, but tell me which is the right stock to buy. I invested, but I lost money. Many common investors make the mistake of assuming that investing in equity means trading in stocks. It's a sad story, but I continuously hear these. Investing in equity means you must invest in a portfolio. You must have a group of stocks. They must be chosen well, and they must be revised. An index is revised when any of the stocks in the index do not do well. When the Satyam crisis broke, the index was immediately revised to drop Satyam and bring in another stock. So a portfolio will do well if it is monitored and revised to hold winners and to drop off the losers. An ETF is a product which does all of this, right? Mechanically, without any manager being there, right? The stock exchange is able to bring these products together and create one single. Instead of buying a single stock, you will buy a bunch of stocks put together at a low cost, and you will be able to hold this for the long term for the benefits of equity. It's a fairly sensible idea to be able to invest in a portfolio like this. The returns are going to be lower than actively managed funds, but in actively managed funds, you will incur costs and you do not know which one is the winner. So that is the summary of what I wanted to say today. Over to you, Niyati and Madhu, for the questions. Thank you very much for your attention.
Thank you, Uma. It was indeed a very insightful session. Yeah, so we have collated some questions which I will take up one by one, and you may answer those. Yeah.
Yes.
Yeah. So the first question is about the horizon. What should be the time horizon for the investment through ETFs in general? A similar question. What should be the investment horizon that one is looking at while investing into ETFs?
Okay. Any equity investment must include at least one bull cycle for you to make return. You can come in anytime, okay? But you should have ridden the market through at least one up cycle to be able to see return and get that buffer. So that next time when the market falls, you have already made some money. So suppose you've invested and no one knows when it is rising or falling. So which means that if you've invested and the market is falling, you have to wait until it rises again. Now, enough studies have been done on cycles and so on and so forth, and how long returns are available, etc. But the answers are very clear. If you do not have at least 7 to 10 years in mind, don't even look at it. Yeah, you must invest in equity for long term. The question of how long is long has been asked several times, and we always tell that if you don't have a 10-year, 7 to 10-year horizon, equity is not your product. Yeah.
Okay, thank you. The second question is about what is the churning strategy should one use to maximize the profits through ETFs? And if somebody has bought the ETF at a dip, how to average if it doesn't reach that price?
Okay. As I said earlier, ETF is a passive product. The question, this question is assuming that return in equity can be made only by actively doing something. It's a very difficult thing to say that do nothing. Either investors think that stock market is a place where someone is sitting with larges and waiting to distribute to everybody. Money is to be made. Someone asked this question: how can I make my 10 lakh into 1 crore, into 10 crores? The market is not a place at all where somebody is giving out freebies. At the same time, the market is also not the place where you have to jump around and do something to be able to make money. ETF is a product in which you can simply float on the waters. You can simply float. You go where the waters take you. So there is no timing in ETF. There is no churning in ETF. There is no tactic in an ETF. It is just this quiet understanding that my money is in a portfolio of good stocks. It goes where these stocks go, and I'm fine with it. So it is for the I don't know if I can use that word, but it's for a sensible, calm investor. It's not for the trader.
Okay, thank you. The next question participant has asked is, with the pending obligations of imports and debts in the coming years, coupled with the flight of capital and Sensex being volatile and rupee sliding to its lowest, how do you see future journeys of ETFs?
I just wrote last week, my last week's column was about all of this. Look, we can be concerned about the macro. There is nothing wrong in looking at the macro environment and asking, will the world end? Will the bees die? And will gold crash? Will the dollar be over? Will China go to war? Now, it's a nice thing, but these are all concerns. But we need to wonder about what we are controlling, right? What is in our hands? What can we control? Do you have a surplus? Please invest it. You don't have a surplus, your money is in the market, don't withdraw it. Just hold on and wait. So the question is, the macro environment can be anything. The market may crash from here. And sitting here, do you think I know when the market will crash and when will it go up? And if I knew it, wouldn't I be there making money? Would I be sitting and teaching and talking to people about markets? So the question is that no one knows to time the market. So if you have surplus, so what drives your investment decision is whether you have a surplus, whether you have a need for cash, and what is the kind of allocation you have. So if you are having a stable income, you're already working, you're not looking for income from your investment, and all your goals are far away, you must simply buy the ETF and not be too worried about the rupee going, where the rupee is going. I understand. I don't intend to dismiss your question. I'm just trying to bring you back to saying that just focus on your job, your income, your returns, and your wealth, and make sure that you have allocated the money. Don't worry too much about timing. It is, may I say, it's wasteful. Don't bother with it. Next question.
Yeah. How are ETFs different from mutual funds? There is a question from one of the participants.
Yes. See, mutual funds are active products. Now, as I said, now assume that you're playing a video game, okay? And assume you're playing any game. And you figured how to win all the time. You will get bored, right? And assume you're playing another game where whatever you may do, you're not able to win. You will give that up also. Which is the game you will play? You will play the game in which sometimes you can win. Now, the stock market is like that. Sometimes you will be able to get a return which is above average, which is a multi-bagger, as we call it, or you have discovered value, or you have done it. Now, funds make it their job. Now, ever since the publication in 1934 of Benjamin Graham's beautiful thesis, it's understood the stock market is not a gambler's den, but a place where good value-creating companies increase in are sought after and therefore will appreciate in price. So the fund management business is based on this premise, where it is possible through a process of analysis to identify well-performing stocks and create an actively managed portfolio that is managing these stocks. In order for them to do this, they will charge a fee, a management fee for their effort, and they will try to get you a alpha. Do they deliver it? Yes. Do they always deliver it? No. So there is this question of choosing the right fund. If they have to choose the right stock, you have to choose the right fund, right? So is there merit in investing in active funds? Yes. But the thing is that there are times when your portfolio must also have a component in which you don't have to indulge in this exercise, right? So that is the difference. So your ETF is your trusted passive idea, which is just invested in the index stocks, and your fund is your active strategy in which you're paying somebody to look for something which will do better than the index and paying him a fee for doing it. These are two different products. Okay, both of them have their place in your portfolio.
Okay.
Next question, ma'am.
Yeah, moving on to the next question. How do we find out ETF's performance and credibility?
See, how do we find out? Index values are published pretty much, they are updated online or they are updated live. If you go to the NSE's website, you will be able to see the index value moving every day, and the index history is also available. Okay, so if you were to look at since inception return for Nifty, it is available online for you to see. So you don't have to really buy any subscription or go and consult anybody. This is publicly available information, updated every trading day. Okay, so it is available and the returns are calculated and published by NSE as well. So this is publicly available information and you should be able to get it easily on the website. Madhu, what was the second part? Where to find performance, and what was the other question?
And credibility. Credibility.
Yeah. Now, credibility is the credibility of the institution, right? Now, here you have two things. You have two layers. You have the underlying company and you have the exchange. The company is listed on the exchange and the exchange and traded on the exchange. The exchange is creating this basket which you can buy as one product, right? Now, this is an operational process. So as long as the exchange is around, the product will be around. Now, but what you must remember is that the exchange is only a conduit, right? It's the underlying businesses. So that's what the index committee does. The index committee is looking at the underlying businesses and saying if some of them lose credibility, if any of them face failure, they will be dropped off the index. There is a clear selection criteria that looks for the liquidity of these stocks, and liquidity is an indicator. The best stocks are the most sought after. Is that right? So therefore, the index committee will be replacing those businesses that don't fail. So in terms of performance, it's transparent, and in terms of credibility, it is dependent on the underlying stocks and is managed by an index committee that actively looks at this. Next question, Madhu.
Yeah, another question for low income group. How is the wealth creation even possible? What steps are necessary to be taken for the low income groups?
Right. See, for someone with a low income, when we say low income, right, what we are referring to is not the absolute amount. What we are referring to is the possibility that their expenses, okay, the money they need for their lives is higher than the income they are earning, which means they are not saving. They don't have any saving. There are times when they are frequently encountering a situation in which they need more money than they are earning. So that's how we look at low income. Now, it's difficult for these categories to be able to build wealth, not because they are poor, but because they don't generate a saving or a surplus. Is that right? So, if that condition is met, now a surplus can be generated. I mean, there are organizations, there are saving organizations which have moved around collecting, deposits of 1 rupee each from simple vendors and created wealth for them. So it is wrong to assume that wealth management is only for the well-to-do or for the rich. As long as you have saving is a personal choice. How much you spend is a personal choice, right? I know it is cruel for a situation in which the money is not enough to cover the basics, right? Thankfully, over the last several years of economic liberalization in our country, several people have been lifted out of their poverty line. This is not to assume that there aren't people who are poor, right? This is not an insensitive comment, but a generalization which says that as long as you can save some money, you can create wealth, right? So whatever you save. The second problem that a low-income group will have is, one, the money may be inadequate and cannot save. The second one is it may be unpredictable, right? You may find that the income is not coming in every month periodically, but there are vagaries to the income, okay? So whenever there is money to be saved, that money can be invested. And products like the ETFs are very low cost and very low amount of money. It's like buying on the index, it's like buying a basket on in the market. So therefore, it is possible to be able to mutual funds, bank deposits, post office deposits, ETFs, and the favored product gold. Gold was when all of this did not exist. Okay, so all of these are available to invest as long as you have a small surplus. So as long as you generate a surplus, investment and wealth creation is possible. It does not directly depend on your level of your income, right? Yeah. Next question, Madhu.
Yeah, we are done with the questions, Uma. Mihir, if you have any questions, participants have shared with you. Please, you can ask also.
No, I think we have covered almost all the questions which have been asked. So no further questions from our side.
Okay.
Great. Yeah. So the summary, I'll just do a 1 minute summary, Mihir. The summary of what we're saying is just this, that money can be made in equity, because equity represents businesses that will borrow in the market at the interest rate that you're getting on other products and create assets. These assets can grow, they can grow in value, and they can generate wealth. So wealth creation to a large extent depends on how much equity you have in your portfolio. Now, equity investing is not selecting stocks or holding 1 or 2 stocks, but equity investment is about holding a portfolio. You must hold a portfolio because different stocks perform differently at different times. You should not only be holding a portfolio, but this portfolio will have to be monitored so that anything that has gone bad is removed. Anything that's not working is removed. And this portfolio should be invested in well-established, good names, typically market leaders, so that it can take business cycles very resiliently. An ETF is nothing but a product which combines stocks traded in the market into a readily available basket. It is a ready portfolio which is available to an investor to buy, and it holds liquid, actively traded stocks and is revised to remove the laggards. So it's available at a low cost. So the positioning in a wealth portfolio is for such products to be a default choice, to be a choice which will allow you to get the market returns without much effort. So that's where ETFs fit. And I do hope, and these products are not pushed as we mentioned earlier. So every investor's portfolio should feature this. I will end by saying that 25% of my portfolio is ETFs. Thank you very much.
Yeah, over to you, Mihir, the closing note.
Yeah, thank you, Uma ma'am, for sharing us your thoughts and for an insightful presentation. I also would like to thank the entire team of CIL for supporting us during the webinar. And last but not the least, I would like to thank all the listeners for attending our webinar. So,
Thank you very much.
every day is a busy day. So I would like to thank. It's already 9:30. So again, I would like to thank all the listeners for attending our webinar, and thank you very much, and have a great evening.
Thank you. Thank you so
Thank you.
much.
Thank you, everyone. Thank you.
Thank you.